Hello friends, wish you a very happy 2025. Well, last week in my video, I discussed what Santa Claus was likely to do because he had just two trading sessions. And guess what? It was a week when he tried but couldn't really manage to do much. In my video of my outlook for 2025 part 1, which I have uploaded very recently, I talked about what I expect in the market and I talked about procyclicality, etc. Now, in this video, I'm going to narrow that focus down. Instead of taking an annual outlook, we are going to break it down to what I expect in the week ahead. So let's dive right in and we are going to discuss some unique features in this week's video. Coming up on your screen is the weekly market roundup, and it tells you that both the indices were moving in divergent directions. So the Bank Nifty fell marginally, whereas the broader base Nifty 50 gained somewhat. The US dollar index continued to rally strongly, and that basically saw the Indian rupee remain under pressure, and it came to again a kissing distance of 86 levels on a closing basis. Now, a strong dollar could not really push the price of bullion lower. Remember, I've been fairly bullish on bullion, and I still feel that if you're willing to look at end of 2025 and even beyond 2025, the rally in bullion is not yet over. Oil and gas went up. A, it's seasonal time, and B, there are basically narratives that are building up to talk about a bullish case. Both, I think, are likely to lose steam over time. Now, the Indian 10-year benchmark bond yield fell very marginally, which means bond prices inched up a little. NSE market capitalization gained 1.89%, which tells me that the up move was somewhat broad-based. MWPL went up routinely post-expiry, and the US headline indices fell. All three fell, which provided headwinds to our markets. Friends, I now come to the ratio chart of the Bank Nifty versus the Nifty 50, and what you can see is a fairly significant decline in this ratio. This is the Bank Nifty divided by the Nifty. So what you are seeing is that banking and financial stocks, do remember the weightage of banking and finance is 34.60%. It is a swing sector in the broad-based Nifty 50. Had it not been for a fall last week in the Bank Nifty, the Nifty itself would have been significantly higher. So what we do want is a rally past the 2.35 levels on this ratio chart, which has remained elusive for months at end. So why do we look at the weightages? The reason is here. I have updated the weightages as of 31st December. These are updated once in a month on the NSE's website, and I've got you the latest reading as of now. Friends, the weekly market roundup done. I now come to our in-house indicators, starting with the MWPL, and what you can see on your screen is the MWPL has risen routinely post-expiry. At 29.92, it is still marginally lower than the previous month's commensurate week, and definitely far lower in the months gone by. Even if you adjust for the 45 new stocks that are added in the F&O list, we are basically showing signs of retail fatigue. They're not writing out as big checks as they were writing 3 to 6 months ago, and I can't blame them. I have been telling you that every month the Nifty has been witnessing sharp declines only to recover, but those mark-to-market payouts have been killers. Now for the stock and index futures turnover, remember these are three concurrent series, so these are January, February and March, and as usual post-expiry the turnover fell. The fall in the stock futures was more noticeable, and do remember, as compared to the prior week, this week was actually 5 full trading sessions. In spite of that, the turnover has gone down. Part of the reason, of course, is higher margins and the higher derivative regime that SEBI regulations have kicked in, and therefore turnover has definitely come down. We need to monitor this aspect very, very clearly. This is something I update on my social media accounts every day. Please do connect with me. My contact coordinates are in the fag end of this video and in the pinned comment below, so you can update yourself in real time. Friends, I now come to the advanced decline ratio, and here you are seeing that the Nifty has made 0.80% gain as compared to 0.96% gains in the prior week, but the advanced decline ratio has moved up sharply. From 0.84 in the prior week, last week we saw 1.51, which means for every 100 losers, there were 151 gainers. Now that is showing signs of higher buying conviction on an intraday basis. Friends, I now come to the Nifty and Bank Nifty prompt futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Exactly like options premium, the basis also shrinks as expiry approaches. Higher the basis, higher the risk appetite, and vice versa. Last week, I remember telling you that such lofty basis readings will not be able to sustain, and look at what's happened. The Bank Nifty basis has fallen 143 rupees, and the Nifty 50 basis has come down even more sharply. It's fallen by more than 50%. Now that tells you at higher levels there was loss of conviction in the bull camp. Of course, the basis is still positive as long as it remains above zero. Bulls do have an upper hand. Friends, I now come to the impetus chart. This is our in-house indicator you've trusted for 4 years now. And what we did see is that the impetus fell sharply last week. In spite of the fact that it was a 5-day trading session week, the impetus has come down very sharply. While it may be a positive indicator for the Bank Nifty because the Bank Nifty fell, and if it fell with lower momentum, that's good, right? But it's bad for the Nifty, which means the Nifty was rising more due to short covering than due to fresh buying, which explains the loss of momentum. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. And what you can see is, even though the Nifty's gains were somewhat smaller as compared to the prior week, the LWTD indicator has finally jumped into the positive segment at 0.60 from the prior week's reading of minus 0.21. Now, this is the highest reading of the LWTD in the 20-week period covered by this chart. And can this sustain? Now, that is something the daily updates that I put up on my social media accounts will tell us. But the statistical weight of evidence seems to tell us that this lofty reading might just correct a bit. But as long as it remains above zero, what we can infer from the high LWTD reading, I beg your pardon, is that at lower levels, there is a likelihood of some support coming in the coming week. Friends, our in-house indicators done. I now come to the bond market, which is something that I monitor very, very closely because this market funds the price discovery of all other asset classes. Bond yields have come down marginally, as you can see on the weekly chart on your screen, and it's still not reached any decisive area where we can take actionable decision as to whether to go for buying the Indian 10-year sovereign benchmark bonds or to deploy money in gilt funds. So I'm sitting on dry powder, keeping my checkbook ready. Friends, the bond market's done. I now come to the Bank Nifty, and as the daily chart on your screen tells you, this index has basically lost ground on Friday, and that too fairly substantially, and that has resulted in a negative reading for the week. Even during the week, this index has risen only on 2 out of 5 trading sessions, and the price remained below its monthly average, which itself is trending lower. So the short-term outlook is nervous as of now. Look at the bold red color trend line, which is a threshold to watch out in the week ahead. it stands at 50,250 levels approximately. Now, this is a support area that you must watch out for. Turning to the weekly chart on your screen, it shows the price is closing below its 6-month long moving average, which is beginning to flatline. That means the medium term outlook is nervous for now, and bulls will need to try extra hard at pushing markets higher. Friends, I promised you I would show you some unique insights into what is happening. Take a look at the rolling return chart on your screen. Do remember, I started warning you from end of October 2021 that I expect cost of funds to go up. This was in line with what I have studied and learned from Dick Stoken's work. Now, from there, the Bank Nifty from October 2021 has risen approximately 22% in a 39-month period. Now, what happens to bulls who practice the buy and rollover long strategy? Obviously, they would be basically out of money. They would be losing if you calculate the cost of carry. If you were to add the cost of funds, which is the interest rate which you're missing out by putting your money to trading, you would basically be seeing hemorrhaging or heavy loss making in the bull camp. Now, do remember that the Bank Nifty, which is the banking and financial sector stocks, have a weightage of 34.60% in the Nifty 50 itself. So these stocks are going to be the swing sector to watch out for in the coming months. Now, friends, in the week before last, this index was number 3 on the statistical beta ranking that I maintain in-house. It slipped 3 notches to number 6, primarily due to the smaller weekly range. So volatility went down, which is welcome from a retail trader's point of view. Last week, I advocated an estimated range between 53,125 on the upside and 49,500 on the downside, which held perfectly well thanks to the narrow range. In the coming week, I estimate a range between 52,700 on the upside and 49,275 on the downside. In addition to this range, please also monitor our daily, weekly, and monthly pivots that I share with you on our free Telegram channel. Also, do not miss out this video, which is a tutorial as to how you should be using our pivot levels to laser precise your trading and earn higher trading profits. Friends, the Bank Nifty done. I now come to the Nifty 50, and as the daily chart on your screen tells you that this index basically gained 0.80% and yet fell on 3 out of 5 trading sessions. It was a rally on Thursday which saved the week, the blushes for the bulls. The price closed below its monthly average after closing briefly above it on Thursday, that is. The average itself is sloping down, so the short-term outlook remains nervous as of now. The price remains below its neckline of both head and shoulder patterns, the bullish and the bearish head and shoulder patterns. The bullish head and shoulder pattern is marked with a blue neckline and the bearish one with a red neckline. So bulls need to push much more harder in the weeks ahead. Switching to the weekly chart, I'm seeing a relatively narrow bodied candle, and it has closed below its 6-month long moving average, which is flatlining itself. So the medium term outlook is that of consolidation. Now, if you see the cost of fund chart here, this is a monthly chart, and when cost of funds started rising from October 2021, the rolling returns are negative if you compute the cost of carry and the cost of funds put together. Now, that is my worry for 2025. And bulls will need to keep the price of the Nifty 50 index, as with the Bank Nifty index, rising at a faster rate than the cost of funds. Otherwise, you actually are seeing negative returns. A non-market participant might tell you that the indices are rising, but hey, you and me are real world traders. We need to calculate the interest cost of funds. And are we making a higher return by putting our money to risk rather than keeping it in a risk-free rate of return like the Indian 10-year sovereign benchmark bond, which the President of India is guaranteeing both the return on and return of capital. This is an aspect which non-market participants are sorely ignoring. I'm sorry, but this thing matters. Now, in the week before last, the index was ranked at number 11 on the statistical beta ranking of volatility that I maintain in-house. It slipped one notch to number 12. Again, a welcome sign. When volatility goes down, the retail guys can handle the trades better. Last week, I advocated an estimated range between 24,525 on the upside and 23,100 on the downside, which held perfectly well. Thanks again to the narrow trading range last week. In the coming week, I estimate a range between 24,725 on the upside and 23,300 on the downside. In addition to this range, please do monitor the daily, weekly, and monthly pivots I share on our free Telegram channel, as also the pivot trading tutorial video, which will help you laser precise your trades. Friends, I now come to the last bit of statistical analysis wherein I analyze the risk appetite in the retail segment by way of their footprint in the 4 derivative segment in the market. And on your screen is the weekly chart which indicates what they have done last week. Now, stock futures turnover contribution fell fairly sharply. No surprise here. Once the expiry is done, the turnover tends to fall. And in the index futures segment, which is indicated as a blue line, the turnover contribution fell by 2 basis points. So in the high risk, high capital intensive segment, turnover contribution fell fairly sharply. Risk appetite, therefore, was lower here. Now, in the relatively less volatile option segment, the index options turnover, which is indicated as an army green line, shot up. The more volatile and more capital intensive stock options turnover contribution fell. The stock option turnover is indicated as a purple line. Now that tells me that overall the risk appetite shrank very, very sharply. This is not something that I'm very happy about. Number one, your turnover is falling. Number two, your MWPL is falling. Number three, the risk component. The traders are taking higher participation in low risk instruments. That tells you that they may not be as convinced as we want them to be about their buy, qualitatively speaking. So qualitatively, the rally is on very thin ice. Friends, I now come to my trading strategy for the week ahead. And what I do think is that I will continue to stick to my hypothesis of procyclicality in the financial markets in calendar year 2025, and my trades will be an extension of this hypothesis. I will constantly seek those counters where bulls are getting garrulous about their long positions, and when they start basically showing signs of aggression, I will start initiating theta decay trades on those counters. I would particularly focus on interest rate sensitives. Now, this has been my bone of contention ever since cost of funds started rising. I will also focus on heavily debt-laden companies and those companies which are very heavily dependent on EMI-based selling. Now, my theme for 2025 will be to focus on very high MWPL or market-wide position limit counters, because that is where crowded exits will occur if and when they do occur. I will not just depend on MWPL, I will use dual filters. Now, these dual filters will be the churn ratio and the ticket size per trade, which I have mentioned in this specific MWPL tutorial. I've prepared you for everything that you need to know for the 2025 calendar year. Bit by bit in 2024, I've been guiding you towards what you should be doing. Now, these dual filters, how will they work? I will basically want to see a change of at least 38.2%. Now, remember, that's a Fibonacci number in the churn ratio and TST over the prior week on a weekly basis, and MWPL, of course, has to remain high. The next point which will trigger a trade after these three filters are met will be the fulcrum and the ricochet points that you have been marking because of the free tick by tick data file of the Nifty propped month futures that I have been putting up on my free Telegram channel. Now, those of you who've been marking these fulcrum points will notice how these fulcrum points are basically either edging higher or edging lower. So those will be your initiation points, that initiation filter. Now this NSE data, the Nifty 50 data file that I have shared with you, the same system will work on every single counter that is traded on any exchange in any part of the world. So if you have a basic rudimentary statistical trading model, as long as you get the data of tick by tick analysis, price, volume, and open interest, etc., you can just run it through and you have your trade ready. Now, I'm still not buying the bull market hypothesis in oil and gas, in spite of the fact that prices are going up. These are more seasonal in nature, and then there are some temporary triggers that have marked these prices higher. Come summer, especially the vernal equinox, and you'll see a change in sentiments. Now, coming to industrial metals, I think metal prices are likely to stay sideways in the week ahead, which means metal mining companies' stock prices will remain range bound with resistance possibly at higher levels. Now, volatility may rise in the month of January, slowly at first, as quarterly earnings numbers start trickling in, and then in the latter part of the month, it will be more towards second guessing and expectations getting built into the sentiments of the impending budget ahead. By and large, pre-budget sentiments tend to be optimistic as traders expect some kind of sops or gifts from the government in a budget, like lower taxation slabs or higher thresholds of tax exemption before taxes start kicking in. So there are these talks already emerging in the public domain, which you are aware about. And this year may see that routine of pre-budget expectation optimism come again. We'll wait and watch as usual, and I will of course be providing you statistical data on my free Telegram channel ahead of the budget, as I have been doing in the last year and the year before that. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos help you become a better trader and what you would want me to record in my next videos. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.